You're listening to the Real Estate Runway podcast, powered by Quattro Capital, where we are all about alternative business and investment strategies to help you amplify life and maximize wealth. Here's your host, the recovering engineer turned multifamily investor, Chad Sutton.
All right. Welcome, friends, to another episode of the Real Estate Runway podcast. I'm your host, Chad Sutton, and I'm joined today with Anthony Scandariato, who is the co-founder of Red Knight Properties. This is a privately held boutique multifamily and mixed-use real estate investment, as well as property management company, with an impressive track record of acquiring and managing portfolios up and down the East Coast that deliver dependable cash flow as well as equity upside. They currently have an assets under management portfolio of about 100 million with just over 750 units up and down that East Coast. So Anthony, without further ado, welcome to the show. Happy to have you on.
Yeah, Chad, thank you so much for having me. I'm excited.
You know, I've had so many rock stars on the show lately that I'm just getting, it's like pinching me. I'm loving talking to all you guys. This is really fantastic. Can you give me an insight into who you are and what kind of got you to this point today? And then I want to talk about some current issues today and how they're driving your decision making.
Yeah, absolutely. So you hit the nail on the head with my bio. A little bit about my background. Before starting my company, I actually worked for another real estate sponsor, and we were acquiring Class A office, believe it or not, multi-tenant up and down the East Coast. So investment grade properties. And I started out as an analyst doing Argus modeling and Excel modeling, and grew into that role. I was there about 6 years, the vice president of acquisitions. But I saw everything. It was small. So asset management, property management, development, construction, you name it. So I really took that experience there and applied it to my company, Red Knight Properties, which you introduced. And, fast forward, I've been in the industry since late 2014. So we're in 2022 now. So fast forward quite a few years. And, now my company, we manage about 100 million and own and manage of our own properties with our investor community. And, it's mostly value add multifamily apartment buildings, Class B. We actually like Class C in B or A areas that we can take to C plus or B minus. Through strategic cosmetic exterior and interior renovations, really drive up rents. I'm based in about 45 minutes west of Midtown Manhattan in New Jersey, to put that in perspective. But we have assets in my area where I started, and the tri-state area, and then also in Florida. So definitely dipping into the Southeast more and more.
It's funny. Your strategy is almost exactly the opposite of Quattro Capital. We are avoiding the coast like the plague, and you are all up and down it. So tell me about investing on the coast a little bit. So it's something that we have been afraid of, but you clearly have done very well with it. Is there any niche or anything you need to know when buying properties up and down the coast?
Yeah, I mean, it really depends. Everything real estate, is local. So I started out by investing in the markets I know. Like I literally bought a property in the same town I lived in to start, and I was also property managing, so I got to learn a lot of that. So I thought that was advantageous and did really well, and just kind of continued to expand around that. So just because I lived on the coast, that's just what I knew. I didn't want to invest in Nashville, or I really like those markets, by the way, Memphis, Nashville, etc. I was looking at some areas like that, and it really intrigued me, but I just didn't feel comfortable. I wanted to start small, and I did, and I wanted to start local, and I did. So it was really local to me, and the areas that we're invested in, I have out-of-state properties now, but I'm able to get there via plane within a couple hours, and I could get a rental car and get there within a half an hour. So it's still relatively local, even though some of them are 1,000 miles away from each other. I hope that helps or makes sense.
It does. Yeah. And I think that you hit a couple of key points on the head there, right? Invest where it makes sense and invest where and can control, right? And to your point, your strategy is, hey, it's a direct plane ride and a 30 minutes to get a rental car and get there. So that's pretty easy. Whereas if you're 3 flights away, you might never go to the property. It sounds like you're on property quite a bit. So
yes,
fantastic.
For
sure. Well, okay, awesome. So you've been doing this a while, right? 2014 sounds like your entrance. You worked for that medical office company for a couple of years, and then took the fundamentals and went off and did your own thing. Have clearly been very successful. So for someone like you, What is driving your decision making today? Because the market's very different than it was in 2014. You have people talking about, man, are the fundamentals still right? Can you still find properties to invest in? What's my risk? So how is what we're seeing in the news and just the current economic environment driving your decision making today? And we'll go from there.
Yeah, and to dive down a little bit more, I mentioned we're investing in Class C, Class B assets, so what we like to call workforce housing, and that term I'm sure has been loosely thrown around. It's not the same as affordable housing, although some components of it are. We really invest in. We look at a lot of different metrics on when we're investing into a city, but number one is obviously jobs, and what number two is really the type of employment. So we like to invest in areas where the tenants who live there in that particular city aren't working from home, aren't really working on the computer. They're going to, a shipping center at FedEx, or they're going to UPS, or they're going to a manufacturing facility to help, with distribution. So we really like to invest in areas where they haven't really been disrupted by the pandemic and have, a decent household median income and job growth, et cetera. So we really like those markets, and we think they're less risky with some of the disruptions that have been taking place. And we're looking at areas that have fundamental population, positive net migration, job growth. Like I said, the type of job growth. Obviously, like to be in a diversified economy. Some of the markets weren't diversified that we're invested in, like Orlando, and now it is. So, we really look at a lot of different things, but number one is jobs and what type of jobs. And, if there's a crash in the economy, are they, or another pandemic happens or whatever, are these essential businesses that are surrounding the area where, people still need to work. I have a lot of nurses and, local service providers that are considered essential. So we really, but even before the pandemic first hit, I looked at trends. The last crash, a lot different than 2020, but it will happen again. It's probably not in the same respects, but some of it will happen. And just kind of learned off that, and I saw how the class, the workforce housing, kind of evolved from that last crash, and where it really dipped, and it really didn't. I mean, it dipped a little bit, but then it kind of slowly went back up. But you got other asset classes like Class A, which drastically went down. Rents went down substantially, and values have therefore went down. And so we really look at the fundamentals. And obviously, right now we have a supply and demand issue in the United States in general. Specific states we're in, like Florida, has as everybody's probably well aware, a large issue with supply and demand just due to population growth. Sure, Tennessee is experiencing the same thing.
Yeah.
So so we like investing in those markets, and we like to invest there before this really started to happen. So now we're kind of taking the position of selling some assets that we didn't think we would sell, we thought we would hold. So that's also driven a little bit by the market. We're kind of towards not the tail end of first quarter yet, but we're in the middle of first quarter. And obviously rates are going to be going up, and that's going to have an impact on values a little bit. We'll see how much they are going to be raised, but we're looking at it as, when we're acquiring an asset, are the fundamentals there from a supply demand perspective, and we really like to buy assets that are mismanaged. So if the rents are below, like stupid below, that's really where we're buying. We're buying very below market rents. Sometimes we'll take lease up risk too. You get a lower basis, and we really come to the perspective of, okay, if I get, if the rents for a 2-bedroom are $500 and the market's $1,200, that's huge. And if the rates even if we don't look at what the market is now, we look at it was what was before the pandemic, because right now we're inflated. So what was before the pandemic market rents, and if they're like substantial like that, rates go up 100 basis points, cap rates blow out 100 or even 200 basis points, we're still good. So that's kind of how I like to look at things. And we're always running sensitivity analyses on, our properties, and, we're not that exit cap rate sensitive, just because we're always trying to I'm not rushing to find a deal. We still find them somehow. I'm not doing 1,000 units a quarter or whatever, but I do probably, one a quarter, give or take. But we're not trying to just run money out the door. We're patient and looking for that right opportunity.
You said a couple of things there. So, the question was really how is what we're seeing in the media, driving your decisions today? And you named a couple of things. I mean, we've heard a lot about the housing shortage in certain parts of the country, and you're in Florida. That's another one. But, the net in migration is so great in some of these areas, and COVID just exacerbated it, right? It drove people out of certain major metros that probably wouldn't have left otherwise due to lack of job freedom or, just being sick of the excessive dense population COVID protocol, right? So all it did was make that better for some of those markets. So the supply and demand is a big thing where you're saying, hey, if I can find a property that is below at least pre-COVID rates substantially, and so that kind of helps you say, okay, well, I can buy this thing. I know the demand's there. I can probably get what I'm going to ask for. And even if you have to buy on somewhat of a compressed cap rate, you can decompress that over time. So you have such a large, equity piece in your deal that even if cap rates aren't as great when you buy it, when you try to sell it, probably still going to do okay, right?
Yeah. Yep. And that's exactly how we look at things. And we're not really buying, unless it's 50% occupied or something like that. We're not buying really low cap rates that I'm seeing a lot of other people buy. It's simply, the type of product we're buying, workforce, Class C apartments shouldn't be trading for 4.5 caps stabilized. They just shouldn't. And even unstabilized, they just shouldn't. So I haven't bought anything kind of less than a 6 cap over the past few years. Just in general, maybe mid fives if you really break it down. But that at that point, I don't really. That doesn't matter as much just because of where we were able to take the properties, and there's such a huge spread. I see some deals where someone's buying Class C property. I just got one today. Fayetteville, North Carolina, 200 units, 3.5 cap going in. It's like 150,000 a unit, 1970s construction, and you can stabilize it at a 5 cap. I'm like looking at it, I'm like, okay, what if interest rates blow out 100 basis points or 200 basis points? You're not going to make any money.
Even where they are today, you're barely in a positive leverage scenario when you get there.
Barely. There's going to be a lot of people that I'm not sure if there's going to be a lot of people getting hurt necessarily, unless they took out long-term debt and they can ride the value drop out, which there'll be some opportunities, hopefully. But I don't see too much distress, but that's why we like to buy. We don't buy necessarily distressed. We buy from motivated seller type of situations.
Yeah. So you and I are probably of this very similar mindset where we're trying to, acquire a true value add, right, at a reasonable cap rate and then decompress that and make a buck, right? We've also talked about some people there's a lot of players out, there's a lot of capital seeking these types of assets. And I want to throw a thought on the table because I know you'll resonate with it. It seems like real estate, namely multifamily, because of its diversified income stream, is starting to be treated like gold. And when I say gold, I mean, like when times get uncertain, money flocks to gold and things like that. Well, this is a tax advantaged asset. It has a diversified income stream. It's growing very well right now. And, it's poised well to ride the inflation curve because, rents typically trend with inflation, what is being asked. So the thought I'd like to throw on the table and see if you see what kind of baseball bat you hit it with. I'm not sure. I've seen it go a couple of ways. We've heard inflation on the news a lot lately.
Every day.
Every day. We know it's happening. It's always happened, right? That's just the nature of having a fiat currency monetary system, which the world is. We know that quantitative easing, which was arguably necessary to keep the economy from seizing up. I mean, currency is the oil of the economy. What are your thoughts on, I guess, what happens to people who are treating these assets as simply maintaining purchasing power? Is that a sound way to think? What do you think is going to happen with the interest rate environment, how that's going to affect property values and these people who are buying ridiculous cap rates at high cost per door? You know what I'm saying? Like, let's get into that conversation a little bit. It's really in the forefront of a lot of operators' minds. Where do you stand on that?
Yeah, I kind of alluded a little bit to it. I'm nervous for the operators who bought at ridiculous numbers and really compressed cap rates at class, maybe even class A, and their business plan is value add, and they're going to hold for 5 years or
By the
three
way,
years.
everything is a value add today, guys. If you're
Well, yeah,
everything.
just that's all you have to say. But um, you know, I am concerned for them. I don't know. It's really a case by case basis. They could have gotten really stupid debt, 2% or 2.5% for 10 years, IO or something. Actually, that's crazy, but something crazy like that, and they're clipping 6 or 7% a year, and they're just riding out inflation or running. So they're low leverage. So there are situations like that. I am nervous for operators that took on very high leverage type of financing, and they thought they're going to get this and these type of rents, and they have to take out the loan within 24 to 36 months, and when the rates go up the values drop, and are they going to be able to pay their debt back, or not even that, just obviously be profitable, that's number one, but pay the loan back. I'd hate to see operators start to go upside down. That would be an opportunity though for a little bit more seasoned operator to come in and scoop some things up. But um, it, it's an interesting phenomenon because inflation has always happened, right? What's the long-term target rate? 2%. Right now, we're not at 2%. I think if you adjust for certain other things that aren't in the CPI number, we're looking at north of 10%, in my opinion. Um, and I haven't. There's a lot of supply chain issues right now. I don't see that really letting up anytime soon. Probably towards the end of it should be less than 2021, but it's still going to be a problem um, due to just various different reasons. We don't need to get into all the reasons, but um, it's interesting because real estate has always been traditionally, oh yeah, hedge against inflation, and it is because if rents outperform inflation, then that's you're beating the curve. A lot of times they don't, or they do, but then guess what? Your expenses are going to go up too. Your taxes go up, your insurance goes up, your utilities go up, and you're kind of just breaking. You're not really seeing growth. Your NOI is staying flat. So, in environments like this where quantitative easing is still going on, um, and rates are stupid low, and rates are going to rise. Hopefully I'm a smart operator and I'm not dumb for starting to sell some assets because you're never going to see these numbers again, in my opinion, that some of these people are paying. So we started to sell. I mean, I'm literally selling assets we bought a year later for double the money we paid. We paid. But we
Likewise,
did
by the
execute.
way. It's a pretty common thing right now.
Yeah. But the thing is, we did execute on our business plan, regardless of how crazy the market is. So we would have been making money anyway. But for us, we didn't want to miss out. And that's kind of my view. I mean, I think the multifamily, there's still a supply and demand issue. States like Florida, Tennessee, Southeast are having that issue. So I think that you're still going to see rents move. Um, when the rates do rise, I don't think people are expecting it, and it's kind of priced in a little bit in some of the market. I'm seeing the market soften a little bit, but it's not. I don't believe it's going to go down. I don't think this Federal Reserve has the cojones to really come out and be strong like Paul Volcker was, and really jack the Fed funds rate up where it's above inflation, and then it basically created a recession over a weekend. I don't know if some probably dates it. I mean, at least that dates me and you probably, but reading in the history books, the weekend rate hike, surprise rate hike, really, really caused a recession. But he did beat inflation. I don't see this Federal Reserve doing that. I think they're kind of going to take it slow, and that could be positive for investors and negative. I don't think high inflation is good at all. I mean, obviously, but you have to be smart. And like you said, real estate is kind of like the gold standard now, particularly multifamily and maybe industrial, and some medical office. That's they have a point. So I'm definitely seeing benefits.
Yeah, I think so. I mean, we're constantly gut checking and you mentioned a beautiful word earlier, by the way, sensitivity analysis. We're also, you can't just underwrite to one scenario. You got to figure out, well, what happens if this happens? What happens if this happens? You kind of create a matrix. And if the sum average of the matrix is good, you buy the property, right? But you don't want to buy something where one point looks good and the whole thing looks bad if the wind blows, But, I'm really having a hard time rationalizing a situation where this asset class gets into too much trouble. Now, you have forces working against it and with it, right? Inflation, rents have always followed inflation. Now, if we get into a hyperinflation scenario, everyone will suffer, but those who will suffer the most are going to be your lower income tenants who are most susceptible to job loss and recession and can barely make ends meet anyway. I mean, trying to get a class B tenant or a class C minus tenant to pay $1,500 in rent, it's going to be tough if their income doesn't go up. But
Yes.
Perhaps the class A and class B tenants do better there. I don't know. But then, talking about interest rate here, there's the thought that it will, as interest rates go up, cap rates go up as well. Well, that's one driver in it. Supply and demand and the amount of capital seeking the asset is also another one. Whether or not we're going to see rate hikes stifle multifamily cost per door, maybe a little bit. To your point, I think it's priced in a little bit, but we also expected to see the pandemic drive. We were ready, capitalized, and hoping to gobble some things up. And I think the best deal I got was 5%, reduction in price. So yes. I don't know. It's interesting to see where we're going to go from here.
Absolutely, and you talk about wage inflation as well. I gotta read the reports over the past couple of weeks and where we're at, but wage inflation is real. It's affecting, definitely from the bottom up first, the most. We are seeing it in white collar too. I think we're in a period of really crazy wage inflation. There's never been a point in time where the employee, at least in my lifetime, the employee has had more control over the employer. Yeah. I mean, you're talking about below 60% labor participation rate as of right now, more people retiring, more people just leaving the workforce. I think that's a problem. I actually think the unemployment is going to go up by the end of the year. And I think the Fed might react by doing QE again. So who the hell knows? What do I know? But I always, like you said, real estate investors, you're always trying to hedge against it. And, we like to buy these Class C properties where, majority of the units are 2-bedroom driven. Yeah. So we have 2 different incomes. So if somebody does lose their job or whatever, or decides to stop working, hopefully the one can support paying. So we look at that as well. There's many different layers in this kind of crazy inflated market. I don't think the United States is going to see hyperinflation. I actually looked at the definition. I think it was like 10% a month. That's not going to happen here.
Yeah. And if you want to see some things like that, go look at some of just Google hyperinflation in country and Google will autofill it for you. You'll see like El Salvador, for example, some of these countries that have truly experienced it where, people were this is where people are having to pay salaries in cash twice a day so that they can go to the grocery store and pay rent before their purchasing power drops again. So it's like, we don't want to get in that situation, but as property owners, we'd be okay, I think.
Yeah. Again, I don't think we're going to experience that. I think it'd be really terrible.
It would be.
It seems like it's coming down a little bit, but it's still here, and it's here to stay. It's not transitory. And you just gotta, you gotta use that. You want to work with inflation, not against it. And, a lot of people, in tough times also hold on to cash. So, I'm not a big proponent of having too much cash, but, because you're going to lose to inflation, but you should still have some cash just in case. And, a lot of currencies, Bitcoin and all these other crypto, whatever, I'm not invested in any of that. There's nothing tangible behind it in my opinion, but I could be wrong. I don't know what I'm talking about. So, I think the real estate's always a good place for me. It's easy to understand. For a lot of my investors and partners, it's easy for them to understand too. We just, it comes down to finding these properties is number one. And then number two is really executing on them the way you said you were going to. And that's why we brought management in-house, just because it is a pain in the ass and it's a lot more work, but we have more control and we're really able to, you know, create value quickly on these properties. So we're not just depending upon the market, help. Obviously, the market's benefited us, but like I said, we still move forward with the business plan. We still spend money. We still got the rent increases we anticipated. We still, you know, implemented the capex. We did the same things. I know some guys that are just taking chips off the table and selling, but without doing anything. We still executed and did it. So we're still going to continue to do the same thing because this market's not going to be like this forever. So.
Yeah, very good. So, I think last question, and then we'll get into a couple of questions I ask every guest on the show just to have a little fun. What's one way your strategy has changed over the last 24 months? And, how are you looking at things differently? Are you, I know you're not planning for 12-month sales, but, what's something that has changed in how you're looking at your real estate investment strategy in light of the pandemic and quantitative easing and interest rate environment? Love to hear it.
Yeah, I mean, I wouldn't necessarily say change. I think we're a little bit more hyper aware and obviously more, I guess, experienced because, we kind of invested through the pandemic, but who the hell knows what the effects are going to be long term. So I wouldn't say they've changed so much. I've always had a philosophy to be conservative with our underwriting. And, we are still I would say we're still very conservative, tightened up a lot with the debt. I mean, at one point, they were making us put up 12 months of principal and interest payments during 2020 for debt. I mean, obviously, we're not doing that anymore, but we have more reserves, on cash on hand that we're raising or putting down. And, we're kind of staggering out some of the construction because of supply chain issues a little bit more than, as quickly as we were used to doing it, just for the base case type of underwriting. And, those are would be the couple of things I would say that would affect your model the most if you do run into hiccups.
Yeah, that makes sense. I mean, who would have thought that lumber would be equivalent to gold and now glass, right? So it's very interesting what's going on in the supply chain. So, okay, well, fantastic, Anthony. Couple of questions I'd like to ask everyone on the show. So, we've heard a lot of your successes here. Give me some dirt, man. What is your biggest failure in this industry and what did it teach you?
Yeah, knock on wood, we haven't had like any deal go bad or any deal go sour or lose any money. But we've made decisions earlier to hire the wrong type of people to work for us in terms of maintenance or leasing, kind of more property management and kind of not having boots on the ground. And when your acquisitions are set up, we kind of did that after the fact. It was still a great deal, but kind of did that after the fact. You should have prepared more. So now every time we do a new acquisition, we kind of, all right, let's hire people ahead of time and everybody's going to be ready to roll day one. So we've kind of let that lag on our earlier acquisitions, but you learn and, we hired the wrong people. We didn't do a background check. We didn't really screen them. Some referrals are great, but you still got to check them out. So, we kind of made those management mistakes from the beginning, but we learned and, we're moving on from it.
Hey, the right people are key, especially on your management team. That is the analogy I love to use is that is the driver behind your race car wheel. You are the GPS. And if GPS can't drive the car, you got to have a good driver. So
yeah,
fantastic. All right. What is your superpower in this industry? What really makes, what is it that you bring to the table that is one thing you can never outsource? And what is your superpower in this industry?
Yeah, I mean, I really love it. I'm very passionate about it, and I could talk to you about this till whenever in my sleep. So very just passion. I think that's kind of kept me driven and motivated to find and scoop up good opportunities just because I'm always doing something.
Yeah, fantastic. I love that. And so here at Quattro Capital, one of our 4 pillars is philanthropy. We have people, property, profits, and philanthropy. I love to offer up a chance for our guests to mention a philanthropy or cause that they tend to get behind so that maybe our listeners will support on your behalf.
Yeah, I had a few family members pass from breast cancer. So actually, we're going to start having an initiative for ourselves as well, most likely coming up. And Susan G. Coleman Foundation for breast cancer awareness. Would like to start doing something there with them, and it's just good to give back to. And we with these communities, we're coming into, and I said this before, we're really trying to. I'm not just trying to go in there and kick tenants out. We're really trying to go in there and improve the community. So and really elevate the area, and make where they live a better place. And I've had I want to say 70 to 80% retention rate. Even sometimes some of these rents are doubling because we're offering them upgrades, or we do new landscaping, new amenity areas, or new sidewalks, whatever. We do upgrades. We're not just going in there and raising rents and doing nothing. So we like to, hopefully that's that little bit of giving back in that respect as well. And yeah, that's pretty much it.
Absolutely. I love that. And last one, so what is the best way to get in touch with you, to learn how to invest with your company, or just to talk, inflation, stagflation, things like that with you?
Yeah. We have a website, redknightproperties.com. That's Red Knight with a K. We have a special report, how to leave your 9 to 5 through financial independence. So you actually just go to our site and it should pop up. I'll send that to you for free. And, all my contact information will be, and you just put your email. I'll send my contact information that way. And, you can reach out to me on there. I'm also on LinkedIn, Facebook, Instagram, Twitter, under Anthony Scandariato, my name, or my company, Red Knight Properties. Either one works. And you can also find us on, we have a podcast called the Discovering Multifamily Podcast. So you can find us on pretty much every platform, and hopefully we'll see Chad on as a guest very soon.
Yeah,
well.
Love to. Be honored. Well, fantastic, folks. And as always, all of that information we just talked about will be in the show notes. So just scroll right on down. We've also noticed our show notes are so long, they haven't all been showing up. So hit the podcast webpage if you don't see it, and it will be all right there in its entirety. You can reach out, get to know Anthony, and see how his company can help you. So, Anthony, thank you so much for coming on the show. We really appreciate the value you've added to our listeners, the market and economic knowledge. I mean, this is a really hot topic right now. So thank you for that.
Thank you, Chad. Pleasure.
All right, everyone. This has been another episode of the Real Estate Runway Podcast. Over and out.
We hope this episode was insightful and brought value to your day. If so, please be awesome and leave us a 5-star review. Find out how Team Quattro can help you at thequattroway.com. Until next time, this is the Real Estate Runway Podcast.